who really buys America's debt now is not a trivia question. It is the hidden switch that controls your mortgage, your stock portfolio, and the speed of the entire economy. It happened quietly, and it should have been everywhere. The Fed started talking about buying Treasury bills again, not as a dramatic rescue, not as a crisis headline, but as a calm little sentence about keeping the plumbing smooth at year end. And that is the tell. Because when the biggest institution in the world says, we are doing this for plumbing, you should hear something else underneath it. You should hear, the system needs a buyer, not someday, not in theory, every week. And the moment you understand who that buyer really is, you stop arguing with strangers about China and you start reading the only scoreboard that matters. Here is the part that stings because it turns the camera back on you. You did that. You parked cash in money markets. You hunted yield in T-bills because finally cash paid something again. You saved yourself from risk. You saved yourself from volatility. You paid without noticing because the cash you moved into safety did not disappear into a vault. It became the fuel that finances the government and stabilizes the bond market. And you pay for that fuel in a different currency, higher interest expense, higher taxes later, higher inflation pressure, and a housing market that moves with every bond auction. If you want this channel to keep mapping the real money flows, hit like, subscribe, and share this with one friend who still says China owns America. Because after this, that sentence will sound like believing a movie trailer is the full film. Now, let us start where the comment wars always start. China owns America. That is the meme. That is the simple story. That is the story that makes people feel like they understand power. But when you run the numbers, the story changes. US debt held by the public is above $30 trillion. China's Treasury holdings are under $1 trillion. If you compare those two numbers, China is a low single-digit slice. That does not mean China is irrelevant. It means the story is not China versus America. The story is who absorbs the next trillion, and the next trillion, and the next trillion, without demanding a panic premium in yield. Because the United States is not funded like a household. It is funded like an auction machine. And an auction machine is only as strong as the marginal buyer. You did that. You saved time by believing the most dramatic villain story. You paid by missing the real buyer sitting in plain sight inside your own financial system. Now, before I tell you who the real buyer is, you need one basic idea that most people never learn. Ownership is not the same as funding. Ownership is who holds the paper today. Funding is who must show up to buy the paper tomorrow. If you want to know who controls the system, you do not stare at yesterday's holders. You stare at tomorrow's auction. Because an auction is a fresh vote. Every week, the market votes. Every week, the market prices the government. Every week, the market decides how expensive it is for the United States to roll its promises forward. So let us build the machine in your head, step by step, with numbers so it stays real. The government spends more than it collects. The gap is the deficit. If the deficit is around 1.8 trillion in a fiscal year, that is not a political slogan. That is a financing requirement. That 1.8 trillion has to be borrowed, not optional, not later borrowed. And borrowing happens through issuance of bills, notes, and bonds. Bills are short-term, months. Notes are medium-term, years. Bonds are long-term, decades. Then primary dealers show up as wholesalers. They do not buy because they love the government. They buy because that is their job in the structure. Then they distribute that paper to the real end buyers. So the question is not, can the government issue? The question is, who has the balance sheet and the appetite to absorb supply at the yields offered? Now, here is the part that changes everything. The biggest buyers are not the people you argue about online. The biggest buyers are domestic liquidity pools, institutions, and the plumbing layer of the financial system. And the reason you never see them in a viral headline is because they are boring. But boring is where the world is funded. Let us start with the buyer you have heard of, but you did not realize how big it became. Money market funds. Money market funds are where cash goes when people want safety and yield. When rates rise, money market funds swell. When money market funds swell, they become a gigantic reservoir of demand for short-term government paper and repo. This is not theory. Money market assets are measured in trillions. That pile of cash is bigger than the entire Treasury portfolio of any single foreign country. And that cash does not sit idle. It buys bills, it lends in repo. It absorbs the short end. You did that. You moved cash to money markets. You saved yourself from risk. You paid because you became part of the buyer coalition that keeps the short end stable. Now, here is a simple way to feel how powerful this is. Imagine an ocean of cash that is $7 or $8 trillion in size. Now imagine the Treasury issues a few $100 billion in bills over a period. That cash can absorb it without blinking. If confidence is stable and the yield is attractive, but if confidence cracks, that cash can also refuse risk instantly and demand only the safest collateral. That is why money market cash has both stability and fragility. It is stability when it buys, it is fragility when it runs to the narrowest definition of safe. Now, the second buyer is banks, and banks are not just buyers, they are balance sheet transformers. A bank can hold treasuries as liquid assets. A bank can fund itself with deposits. A bank can use treasuries as collateral. So when yields move, banks shift their posture. This matters more than people realize because banks are huge. When a large bank decides to hold more treasuries, that can soak up supply. When a large bank decides to hold less, the market feels it. And this is why a story about bank reserves and balance sheets can move bond yields. Even when the economy did nothing dramatic that day. You did that? You assumed the banks are just loan machines. You saved yourself the effort of learning that banks are also the largest bond warehouses on earth. You paid because when the warehouse shifts, the price of money shifts. Now, the third buyer is the Fed. And this is where the story becomes uncomfortable. The Fed insists it is not there to fund the government. The Fed insists it is there to manage monetary policy and financial stability. But here is the reality. When the system is under pressure, the Fed's actions can become the difference between calm funding and a sudden spike in yields. If the Fed talks about buying bills to manage reserves, the market hears something simple. A large, consistent buyer is stepping into the short end. Even if it is called plumbing, it is still demand. And demand is the difference between an auction that clears easily and an auction that clears with pain. You did that. You thought the Fed was a distant institution that only matters to economists. You saved yourself from watching the Fed's footprint in the bond market. You paid because the Fed's footprint changes the entire discount rate of your future. Now, the fourth buyer is foreigners, but not the meme version. Foreigners still matter. Foreigners can be a meaningful layer, but foreigners are not the whole foundation. Foreign official holdings can drift. Foreign private buyers can surge when yields look attractive. Foreign flows can flip month to month. So foreigners are a variable, not a guarantee. And that is the key. A guarantee buyer is what stabilizes an auction machine. A variable buyer is what creates risk premiums when supply is heavy. This is why the more important story is the domestic buyer coalition, because domestic pools tend to be more structurally tied to the system. You did that. You watched foreign headlines. You saved yourself from tracking domestic absorption. You paid because domestic absorption is the part that decides whether yields trend higher, lower, or snap violently. Now, here's the fifth buyer that people forget because it is not a single institution. Pensions and insurance. They buy duration when yields are attractive relative to liabilities. They are not chasing headlines. They are matching cash flows. When long-term yields rise, their future obligations become easier to fund, and they can lock in returns. So when you see yields spike, do not assume everyone hates bonds. Some large liability-driven buyers love higher yields because higher yields solve their math. That is why bond markets do not move in straight lines. Higher yields can attract new buyers, but only if the market believes the higher yields are stable, not just the start of a panic. Now, let us put the myth in a box, because this is where the viewer finally stops wasting energy. If a foreign country holds under 1 trillion of treasuries, it can cause volatility if it sells, but it cannot single-handedly decide the fate of a market that is tens of trillions in size. The deeper power is not who owns a slice today. The deeper power is who is structurally forced to buy tomorrow. The buyer of last resort is not a country. It is a coalition of domestic cash, pools, banks, dealers, the plumbing layer, and sometimes the Fed when the system tightens. Now let me make the hidden bill feel real, because until you feel it, you will treat this like an interesting documentary instead of a map of your life. Net interest expense for the government has been climbing toward the $1 trillion neighborhood. That means the government is paying close to $1 trillion a year just in interest before it funds defense, healthcare, infrastructure, or anything else. So the government is running a subscription model. The debt stock is the principal. The interest is the subscription fee. And when rates rise, the subscription fee rises. If the average interest rate on the debt rises even 1 percentage point across a very large portion over time, the interest bill rises by hundreds of billions. And that interest bill has to be paid by taxes, inflation, spending cuts, or more borrowing. That is the loop. You did that. You enjoyed the world when rates were near zero. You saved money on interest as a society. You paid by building a debt structure that becomes sensitive when the rate climate changes. Now, here is where I am going to give you the first prize. But you have to earn it, because if I just hand it to you, you will misuse it. The prize is the answer to this question. If China is not the boss of the debt market, what is the real stress point? The stress point is not a headline. It is auction digestion. It is the difference between supply and buyer capacity at the margin. In other words, how many dollars of new treasuries must be sold and how many dollars of natural demand exist that week? If supply outruns demand, yields rise. If yields rise, the discount rate rises. If the discount rate rises, asset prices fall, especially long duration assets that are priced on far future cash flows. That is why your tech stocks care about bond auctions. That is why your real estate cares about bond auctions. That is why your business loan cares about bond auctions, because treasuries are the benchmark. They are the base price of money. Now you can start mapping companies the right way, not by headlines, by mechanisms. When yields rise, money market platforms benefit because cash yields look attractive. Think about the platforms and asset managers that capture cash and build demand. BlackRock runs enormous money market and bond complexes. Charles Schwab sits close to cash sorting behavior. Large asset managers and brokers benefit from cash allocations and fee flows depending on the mix. When rates are high, the short end becomes competitive with risky assets and flows shift. You treated cash like dead money. You saved yourself from noticing that cash becomes an asset class when yields rise. You paid because flows into cash can drain demand from risk assets. Now banks, JP Morgan Citi, and other large banks sit on deposit basis and balance sheet capacity. When yields rise, they can allocate into treasuries and earn spread. But they also face mark-to-market risk on securities and credit risk on borrowers. So they can benefit and suffer depending on how the move happens. Slow moves can be managed. Fast moves create shocks. So the winner is not just the bank. The winner is the bank with stable funding and risk controls. Now, market infrastructure, CME Group and Intercontinental Exchange benefit from rate volatility and hedging activity because the more the bond market moves, the more people hedge. Hedging creates volume. Volume creates fees. That is why the most boring businesses can quietly do well during uncertainty, because they are toll booths. Now, custody and collateral plumbing, Benign Mellon and State Street sit in the world of custody, settlement, and collateral services. When funding is tight, collateral is king. And when collateral is king, the plumbing firms become more important. Now, you might be thinking, okay, but where does this show up in politics? It shows up in statements that sound boring. It shows up in Treasury refunding language about expected borrowing needs. It shows up in the Fed talking about reserves, repo facilities, and bill purchases. It shows up in debt ceiling drama when cash balances swing. And it shows up in election year narratives about deficits and spending, but the market does not vote with speeches. The market votes at auctions. So the political story matters only because it changes expected supply or expected demand. If policy increases deficits, supply rises. If regulation changes bank balance sheet capacity, demand changes. If foreign relations shift reserve behavior, demand changes. This is why the debt market is political, but it is not emotional. It is arithmetic. You did that. You got pulled into political theater. You saved yourself the effort of tracking the auction machine. You paid because the auction machine is what prices the theater. Now, let us lock one more idea into your head, because this is the thing that makes the whole topic click. There is a difference between who holds, who trades, and who must show up. Some holders are sticky. Some are fast money. Some are forced by mandate. Some are forced by structure. Money market funds are often structurally pulled toward bills and repo when yields are attractive. Banks are structurally pulled toward treasuries as liquidity assets within regulatory constraints and profitability. Pensions and insurers are structurally pulled toward duration when yields match liabilities. The Fed is structurally pulled toward interventions when plumbing threatens financial stability. That is the coalition. And this is why the system can survive foreign selling, but it can struggle if domestic absorption is constrained at the same time, supply is heavy. Now, before we go further, do one thing, because it tells me what you want more of. If you want the next part, where we map the exact stress signals that show up before a funding scare, hit like, subscribe, and share this with a friend who thinks government finance is just politics, because it is not. It is an auction machine. Now, here is the question that sets up the rest of this story. If the real buyer is a domestic coalition, what happens when the coalition gets tired? What happens when money markets stop growing? What happens when banks hit balance sheet constraints? What happens when auctions get larger? What happens when net interest approaches $1 trillion and deficits stay in the trillion range? Do yields spike? Do stocks reprice? Does the Fed step in, or does the system just pay a higher premium and keep going? That is the next prize. Because once you can answer that, you stop being reactive. You stop getting hit by surprise yield moves, and you start positioning around the only thing that matters: supply schedules, buyer capacity, and the stress gauges that show the coalition is tightening. Now we are going to build those gauges, and then we are going to map exactly how they hit the stock market. Which sectors get squeezed when yields jump? Which companies benefit when cash piles grow? And which names can quietly thrive when volatility becomes the new normal? First, you watch the auction itself, because the auction is where the market tells the truth with money. An auction can look fine on the surface and still be a warning sign underneath, like a smile hiding a cracked tooth. So you watch the bid to cover ratio. If an auction gets 2.5 times bids for the amount offered, that looks healthy. If it slides toward 2.0, demand is still there, but it is thinning. If it slides toward 1.8, you are starting to see strain. Now combine that with the tail. If the auction clears exactly where the market was trading, the tail is near zero. If the auction clears to basis points above where the market was trading, that is a small tail. If it clears 5 basis points above, that is a bigger tail. If you start seeing repeated tails like that week after week, that is the coalition demanding a higher premium to absorb supply. You did that. You watched the yields move after the auction and thought it was random. You saved yourself the boring step of watching the auction mechanics. You paid because the auction is the first place. The market price is stress. Now you watch who is forced to take paper. Primary dealers. If end buyers do not show up strongly, dealers end up holding more inventory. That inventory has to be financed. And when inventory grows, the dealer balance sheet gets heavier. When the dealer balance sheet gets heavier, the dealer demands more yield. That becomes a loop. More supply leads to more dealer inventory. More dealer inventory leads to more financing needs. More financing needs leads to higher term premiums. Higher term premiums lead to tighter conditions. This is why the phrase, "who is the marginal buyer," is not a philosophy question. It is an inventory question. Now you watch the short end reservoir, because the short end is where cash hides and then reappears. Money market fund assets are the signal. If money market assets are growing, it means cash is choosing bills and repo over risk. That can actually support Treasury demand on the front end, but it can also drain demand from equities. So it is a double-edged signal. If money market assets rise by 1 trillion over a period, that is 1 trillion of potential bid for bills and repo collateral. If the average bill yield is 5%, 1 trillion at 5% is 50 billion per year of interest income being paid to cash holders. That income is not free. It is paid by the government's interest expense line. So when cash gets paid again, the government subscription fee rises. You did that. You celebrated that. Cash finally yields. You saved yourself from taking risk. You paid because the government pays that yield and the bill comes back through the system. Now you watch the Treasury's cash balance behavior. The Treasury General Account is like the government's checking account. When the Treasury spends down cash, money flows into the private sector, reserves tend to rise, and liquidity can feel easier. When the Treasury rebuilds cash, money flows out of the private sector. Reserves can tighten and liquidity can feel harder. So a simple thing like the Treasury rebuilding cash can tighten conditions even if the economy did nothing. If the Treasury decides to rebuild 300 billion of cash over a few months, that is 300 billion of liquidity being pulled from somewhere. That is why markets can wobble around tax dates and big settlement weeks. You did that? You blamed market moves on vibes. You saved yourself from tracking the government checking account. You paid because liquidity is math, not mood. Now, you watch bank reserves and the plumbing rates. When reserves are plentiful, funding markets are calm. When reserves approach the lower comfort zone, funding becomes jumpy. Then you see it in repo rates and overnight benchmarks. A move of 20 basis points in overnight funding can look small, but in the plumbing world it is a flare because it tells you that balance sheet is becoming scarce, and scarcity is what forces the Fed to talk about plumbing again. You did that. You thought the Fed only matters when it moves rates? You saved yourself from watching reserves and repo. You paid because plumbing stress hits asset prices before the news explains why. Now you watch the shape of the yield curve in a way that actually matters, not because the curve is a fortune teller, but because the curve is a cash flow machine. If the 2-year yield is 4.5% and the 10-year yield is 4.5%, the curve is flat. If the 10-year rises to 5.0 while the 2-year stays 4.5, long duration costs just went up. That hits mortgages, corporate borrowing, and valuation multiples. A mortgage rate is not set by the Fed funds rate alone. It is heavily influenced by longer-term yields and spreads, so the long end is where the housing market feels the auction machine. If mortgage rates move 1 percentage point higher and the average borrower's purchasing power drops about 10%, that is not a debate. That is our wow. That is why home builders and real estate react so hard to rates. You did that. You looked at the Fed and ignored the long end. You saved yourself from tracking the auction premium. You paid because the long end is where the market prices deficits and supply. Now you watch net interest like a pressure gauge because net interest is the bill that grows automatically. If net interest is around 1 trillion and the deficit is around 1.8 trillion, then interest alone is more than half of the deficit scale. That changes the story because now a big portion of new borrowing is borrowing to pay for the subscription fee. If the government borrows 1.8 trillion and pays 1.0 trillion in interest, you can feel how the loop tightens. Even if you cut other spending, interest does not politely step aside. It demands payment first. And if average rates on rolling debt stay elevated, net interest stays heavy. So the question becomes, how long can the coalition absorb supply at these yields without demanding a higher premium? Now let us answer the big fear question in a clean way. What happens if the coalition gets tired? There are 3 broad outcomes. The first outcome is yields rise until buyers show up. That is the simplest market solution. If buyers hesitate at 4.3%, the market offers 4.7. If buyers hesitate at 4.7, the market offers 5.1. Achisomi point, pensions, insurers, and global capital step in because the yield is too attractive relative to alternatives. That is the market clearing itself. But it is not painless because higher yields are tighter conditions for everything else. The second outcome is the Fed smooths the short end and supports liquidity so the coalition can keep absorbing without a funding seizure. That can keep the system functioning even if the long end remains pressured. You can have calm plumbing and still have a heavy term premium. That is why risk assets can bounce while mortgages stay stubborn. The third outcome is a policy mix that reduces future supply expectations. If deficits shrink from 1.8 trillion toward 1.2 trillion, supply pressure eases, but getting from 1.8 to 1.2 is 600 billion of change. That is not a small trim. That is either big spending cuts, big tax increases, or big growth plus time. So it is slow. That is why markets focus on what will happen next quarter, not next decade. You did that. You expected one clean answer. You saved yourself from living in probabilities. You paid it because markets are probability machines, not certainty machines. Now let us translate those outcomes into what happens to stocks with mechanisms, numbers, and company names so viewers can actually map it. Start with the simple truth. Higher yields are gravity. The higher the risk-free rate, the less investors are willing to pay for distant cash flows. So long duration equities feel it first. A company trading at 40 times earnings is priced like the future is worth a lot today. If the discount rate rises, the same future is worth less today. That does not mean the company is bad. It means the math changed. So in a rising yield environment, the market tends to reward cash flow now. not promises later. That is why you often see pressure on the most expensive growth segments when real yields rise. Now look at the winners when yields stay high. Money, market, complexes, and platforms. BlackRock, for example, benefits from flows into cash and bond products as investors seek yield and safety. Schwab sits close to cash, sorting behavior as clients move between deposits, money, funds, and bonds. Exchanges and clearinghouses can benefit from rate volatility. CME Group and Intercontinental Exchange can see volume rise when rates move and hedging demand increases. The plumbing companies matter to Benny Mellon and State Street sit in custody, collateral, and settlement. When collateral demand rises and money market activity stays high, their role becomes more valuable. Now banks, JP Morgan, Citi, Bank of America, when yields rise, net interest income can rise, but only if funding costs do not rise just as fast. And the risk is credit. If yields rise fast, borrowers strain. So the bank story becomes who has the strongest deposit base, who has the best underwriting, who has the least exposure to weak credit at the wrong moment. This is why you do not just say banks win with higher rates. You ask, do banks win with higher rates if the move is smooth? Do banks still win if the move triggers defaults? That is the difference between a controlled climb and a cliff. You did that. You bought sectors like they were single levers. You saved yourself from reading how those sectors actually earn money. You paid when a single move in yields hit different companies in the same sector in opposite ways. Now, the losers when yields stay high. Housing sensitive names. Home builders like D.R. Horton, Leonard Polter Group, because affordability is the gate. If mortgage rates rise from 6 to 7%, the payment on the same home price rises roughly 16% on the interest portion. And for many borrowers, that is enough to disqualify them or force a cheaper home. So volumes slow, margins can compress if incentives rise. REITs and utilities can struggle when financing costs rise because they often rely on steady yield like cash flow and debt financing. If a utility yields 4% and treasuries yield 5%, the market demands a repricing unless the utility has a strong growth or pricing story. Now, the real sleeper risk is companies that survive by refinancing. If a company has thin margins and large maturities, a higher rate environment can squeeze it. Imagine a company with 10 billion of debt and it refinances 5 billion at a rate 2 points higher. That is 100 million more in annual interest expense. If that company earns 300 million in operating profit, that 100 million is 1/3 of its operating profit gone. That is how refinancing becomes a slow motion crisis. You did that? You looked at earnings and ignored interest coverage. You saved yourself from reading the maturity wall. You paid because the bond market punishes weak balance sheets quietly and then all at once. Now, flip the scenario. If the Fed smooths the short end and liquidity improves, risk assets can breathe. Shorttermfunding.com reduces forced selling. That can lift equities, especially if investors believe the long end will eventually stabilize. But here's the key. If deficits remain heavy, the long end can stay stubborn. So you can get a world where stocks rally and mortgages stay high. That confuses people. But it is normal because the short end is liquidity and the long end is supply plus inflation expectations plus term premium, two different engines. So your job as a viewer is to stop treating it like one dial. It is multiple dials. Now, let us bring it back to the simplest scoreboard you can repeat. Supply, demand. Clearing price, supply is demand is the coalition. Clearing price is yield. If issuance rises and demand does not rise, yield rises. If yield rises, discount rates rise. If discount rates rise, asset valuations compress. So the bond market is the foundation under the stock market, whether people like it or not. You did that. You treated bonds like a boring corner. You saved yourself from learning the foundation. You paid because you built a portfolio on a foundation you never measured. Now let us get practical in the way adults and markets behave. You do not need to predict the perfect path. You need to avoid being forced. So you build a cash buffer. If your monthly expenses are 3,000, then 6 months is 18,000. If it is 5,000, 6 months is 30,000. That buffer is not a flex. It is the ability to wait. Then you decide your duration exposure intentionally. If you buy a long bond fund, understand that you are buying sensitivity to yields. If yields rise 1%, A long duration bond can drop around 15 to 20% depending on duration. That is not a surprise. That is the product. If you cannot tolerate that, you keep duration shorter, like ladders of bills and short notes. Then you build your equity exposure around resilience, pricing power, strong free cash flow, low refinancing risk, companies that can absorb a higher discount rate and still produce cash. If a company has a 5% operating margin and a shock equal to 1% of revenue hits costs or financing, operating profit drops about 20%. If a company has a 25% margin, the same shock is about 4%. So margins are armor. Balance sheets are armor. Now, because people always ask for a simple checklist, here is one you can hold without being fooled by headlines. If auctions start tailing consistently, demand is thinning. If dealer takedown rises, end buyers are stepping back. If money market assets surge, cash is hiding and the short end is supported, but risk assets can be drained. If repo rates jump around quarter end, balance sheet is tight. If the Treasury is rebuilding cash aggressively, liquidity can tighten. If the long end rises while inflation expectations stay flat, term premium is rising and supply pressure is being priced. If net interest keeps climbing toward $1 trillion, fiscal pressure becomes more sensitive to rates. You did that? You looked for one magic headline. You saved yourself from watching the gauges. You paid because the gauges warn you before the headline exists. Now we close with the prize answer, because this is what the video title promise. Who really buys the debt? Not a country. Not a single villain, a rolling coalition, money market funds, and cash pools buying bills, banks allocating balance sheets into treasuries when yields are attractive, dealers warehousing and distributing paper, pensions and insurers stepping in when yields solve their liability, math, foreign private and official flows, adding a layer but not running the show, and the Fed occasionally stepping in on the short end to keep the plumbing from freezing, because a frozen plumbing system is not a debate. It is a crisis that is the real map. And when you see that map, you stop arguing about yesterday's holders and you start watching tomorrow's auctions. If this changed how you see the world, hit like, subscribe, and share this with a friend who still says China owns America, because the truth is more interesting and more useful than the meme. And tell me in the comments which part you think is the real breaking point. Is it the auction tails? Is it dealer balance sheet limits? Is it net interest approaching $1 trillion? Or is it the simple reality that a $1.8 trillion deficit requires a buyer every week forever? Because your answer tells me what you want next. In the next episode, we will take this one level deeper and expose the next battle line, the bond vigilantes versus the Fed, and why the next yield shock will not feel like a recession headline at first. It will feel like a quiet auction that suddenly costs more than anyone expected,